When you're trying to buy an investment property, one of the first questions you face is, how am I going to pay for this thing? And for most people, it comes down to two options: a traditional bank loan or hard money. Now, if you've never dealt with either one, it's easy to get confused. Banks sound safe and cheap. Hard money sounds expensive and sketchy. But the reality is a lot more nuanced than that. And depending on where you are in your investing journey, one of these could save your deal while the other one kills it. So let's talk about what each one actually is, when they make sense, and which one you should be using in 2026. Let's start with bank loans. When most people think about financing real estate, this is what they picture. You walk into a bank, you fill out a mountain of paperwork, they check your credit, they verify your income, they look at your tax returns, and if everything checks out, they give you a loan at a relatively low interest rate, usually somewhere between 5 and 8%, depending on the market. The terms are long, often 30 years. The payments are predictable, and if you qualify, it's one of the cheapest ways to borrow money. But here's the thing: banks are slow, and they're picky, really picky. They want to see 2 years of tax returns. They want proof of income. They want a good credit score, usually 680 or higher. They want the property to appraise perfectly. And even if you have all of that, the process can take 30 to 60 days or more. If you're trying to close fast on a deal, that timeline alone can cost you the property. Now let's talk about hard money. Hard money loans come from private lenders, not banks, and they work completely differently. Instead of focusing on your credit score or your income, hard money lenders focus on the property, specifically the value of the property and how much equity is in the deal. They're asking one main question: if this borrower doesn't pay me back, can I sell this property and get my money out? That's it. Because of that, hard money is fast. We're talking 5 to 10 days in a lot of cases, sometimes even faster. There's way less paperwork, no tax returns, no employment verification, no waiting on some underwriter 3 states away to approve your file. You bring a good deal, you get funded. But speed comes with a price. Hard money loans are expensive. Interest rates usually run anywhere from 9 to 15%, sometimes higher. The terms are short, usually 6 months to 2 years, and there are often upfront fees, sometimes called points, that can add up to 2 to 5% of the loan amount right off the bat. So why would anyone use hard money if it costs so much more? Because in real estate, speed and flexibility often matter more than price. Let's say you find a distressed property at an auction. It needs work, but the numbers are solid. You can buy it for $120,000, put $30,000 into it, and sell it for $200,000. That's $50,000 in profit. But you need to close in 7 days, and the property won't qualify for a bank loan in its current condition because the roof is half gone and the kitchen's gutted. A bank won't touch that deal, but a hard money lender will. They'll lend based on the after repair value. You close fast, you fix it up, you sell it or refinance it. You pay off the hard money loan, and you're done. Here's another situation where hard money makes sense. You already have a few rental properties in your name, and your debt-to-income ratio is maxed out. A bank says, sorry, you're too leveraged. A hard money lender doesn't care about your DTI. They care about the deal. If the property cash flows and the numbers work, you can still get funded. Or maybe you have bad credit, a recent foreclosure, or you're self-employed with tax returns that show little income because you write everything off. Banks will shut you down, but hard money lenders look at the equity, not your credit report. Now, does that mean hard money is always better? Absolutely not. If you're buying a clean, livable property, and you have good credit, stable income, and time to close, a bank loan is almost always the smarter move. You'll save thousands in interest, have a longer term to pay it back, and you won't be under pressure to flip or refinance quickly. The key is knowing which tool to use for which job. Hard money is a short-term tool for speed and distress deals. Bank loans are for long-term holds and stability. Many investors use the BRRRR method: buy, rehab, rent, refinance, repeat. Starting with hard money and then refinancing into a low-cost bank loan. That's the sweet spot between speed and cost. So here's the bottom line. Hard money and bank loans aren't good or bad, they're just different. The right choice depends on your situation, timeline, and the deal in front of you. Don't fear hard money just because it's expensive, and don't assume a bank loan is always best just because the rate is lower. Look at the whole picture. If you found this helpful, hit the like button and subscribe. We post videos every week to help you understand real estate financing. Got a deal you're working on and unsure which route to take? Drop a comment below. Thanks for watching, and I'll see you in the next one.